Stop whatever you're doing right now. Pause. Close the other tabs. Turn off the noise around you. What I'm about to walk you through is not a conspiracy theory, not a rumor, and not speculation. This is arithmetic. Simple, unforgiving arithmetic. And once you understand it, you'll see why one of the largest banks on earth may already be standing on a trap door. And the rope is tight. The number you need to remember is 4.2 billion ounces. That is the estimated size of J.P. Morgan Chase's total silver short exposure, based on analyst reconstructions using publicly available data from the Office of the Comptroller of the Currency, CFTC commitments of traders reports, COMEX warehouse statistics, and decades of pattern analysis by veteran metals researchers. Is it exact? No. Could it be off by 20 or even 30%? Possibly. But here's the critical point. Even if that number were cut in half, the math still breaks. Now put that 4.2 billion ounces into context. Global silver mining produces roughly 800 million ounces per year. Divide 4.2 billion by 800 million and you get about 5.25. That means J.P. Morgan is effectively short more than 5 years of total global silver production. And now comes the part that should make your blood run cold. The amount of registered silver currently available for delivery on the COMEX, the metal that can actually be delivered against futures contracts, is around 123 million ounces. That means J.P. Morgan's estimated short exposure is roughly 34 times larger than the entire deliverable supply. This is not David versus Goliath. This is David versus God. And in markets, when the math stops working, something breaks. Either the short breaks or the price breaks. There is no third option. Before I go any further, I need to be absolutely clear about what this is and what it is not. This is not insider information. There are no leaked documents. There are no secret memos. Everything here is based on publicly available data and scenario analysis. This is an if-then exercise. If J.P. Morgan is short on the scale analysts estimate, and if they are forced to cover in a compressed time frame under current market conditions, then this is what the math, the structure of the market, and historical precedent suggest could happen. You decide whether that scenario is plausible. The OCC's quarterly report on bank trading and derivatives shows that U.S. commercial banks hold over $1 trillion in precious metals derivatives. J.P. Morgan holds the largest share. The report doesn't specify gold versus silver or long versus short, but we can triangulate using other data. The CFTC's commitments of traders reports show that the commercial category, which includes banks, holds a massive net short position in silver futures, around 350 million ounces just on COMEX. That figure excludes over-the-counter derivatives, options, and London market exposure. Analysts who have studied J.P. Morgan's behavior for years estimate that when all venues and instruments are included, the total short exposure approaches 4.2 billion ounces. Why would a bank accumulate a position like this? Not because of a single reckless bet, but because of decades of normal banking activity. J.P. Morgan acts as a market maker. It facilitates trades for clients, hedges mining production, manages industrial demand hedging, and runs risk management positions that are never perfectly offset. Over time, these exposures compound. Add in proprietary positioning under the guise of hedging, and you get a massive net short that was manageable when silver was $20 or $30, but becomes lethal at 90. At today's prices, the losses are no longer theoretical. If the average entry price of those shorts is around $60 per ounce, a conservative assumption, and silver is trading near 90, that's over $30 of loss per ounce. Multiply that by 4.2 billion ounces, and you're looking at roughly $128 billion in mark-to-market losses. J.P. Morgan's total Tier 1 capital is about $250 billion. That means silver alone could represent roughly half of their capital base. And if silver keeps rising, the situation escalates fast. At $100, the losses approach $170 billion. At $120, nearly $250 billion. At that point, regulators don't look away. They step in. There are 3 potential triggers that could force covering, and each one alone might be manageable. Together, they become checkmate. The first is a COMEX delivery failure. If a large percentage of longs stand for delivery in March, the registered inventory simply isn't enough. Cash settlement or emergency sourcing becomes unavoidable. The moment confidence in paper delivery cracks, physical premiums explode. Paper silver becomes a promise. Physical silver becomes reality. And reality trades at a higher price. The second trigger is regulatory pressure. When derivative losses threaten capital adequacy, regulators don't negotiate. They issue directives, reduce exposure, or raise capital. Raising tens of billions in new capital under crisis conditions is nearly impossible. Covering shorts becomes the only option, and covering means buying in a market with no supply. The third trigger is China. Shanghai silver is already trading at a persistent premium to COMEX, and export restrictions have turned that premium into a one-way valve. Silver can enter China, but it doesn't leave. Every dollar that premium widens drains Western inventories. JP Morgan and China are competing for the same finite metal, but only one of them has unlimited time. The bank does not. If these forces converge, covering does not happen gradually. It happens violently. Forced buying feeds higher prices, which trigger more margin calls, which force more buying. That feedback loop only ends when the short is gone. History gives us a reference point. In 1980, the Hunt brothers controlled about 2/3 of 1 year's global silver supply. The price rose from $6 to $50 in less than a year, an 8-fold increase. Today, the relative scale of JP Morgan's position versus supply is far larger. Even if the price impact is a fraction of that episode, triple-digit silver is mathematically reasonable. A move toward the mid-300s is not radical. It is conservative under stress conditions. In a forced cover scenario, the market bifurcates. Paper silver trades at one price. Physical silver trades at another. The spread reflects delivery risk. Promises are discounted. Metal commands a premium. That divergence already exists today in small form. Under stress, it explodes. JP Morgan will fight this with every tool it has, negotiating with longs, lobbying exchanges, raising margins, coordinating media narratives, securing emergency liquidity. But none of those tools create silver. Dollars can be printed. Metal cannot. And that brings us to what this means for you. If you hold physical silver, you are holding something the system may desperately need. Not a paper claim, not a promise. Actual supply. That gives you leverage in a market where leverage disappears everywhere else. This does not mean the scenario is guaranteed. Estimates can be wrong. Timelines can shift. Intervention can delay outcomes. But the imbalance is real. The deficit is real. The inventory drawdown is real. The price pressure is real. If this unfolds, volatility will be extreme. There will be sharp pullbacks, panic headlines, and emotional pressure to sell early. Understanding the mechanics ahead of time is the difference between reacting and deciding. This was not a prediction. This was scenario analysis, a mathematical projection of what happens when an oversized short collides with insufficient supply under regulatory and geopolitical stress. The math does not bend to narratives. When it fails, markets break. If you found this analysis valuable, stay connected. I will continue tracking the data in real time. Inventories, delivery ratios, premiums, and regulatory signals. If the scenario activates, the indicators will show it. If it doesn't, we'll know that too. The number you need to focus on is 4.2 billion ounces. That is the estimated size of JP Morgan Chase's total silver short exposure, reconstructed by analysts using publicly available data from the Office of the Comptroller of the Currency, the CFTC's Commitments of Traders reports, COMEX warehouse statistics, and long-term market behavior. This figure is not presented as a precise measurement. It is an estimate. It may be off by 20%. It could even be off by 30%. That level of uncertainty is real and should be acknowledged. But accuracy to the decimal point is not what matters here. Even if the estimate were significantly overstated, even if the real exposure were only half this size, the position would still be enormous by any historical or structural standard. At that scale, the conclusion does not change. The imbalance remains extreme, the market structure remains distorted, and the mathematics still fail. When numbers grow this large, uncertainty does not remove the risk. It only delays the moment when the system is forced to confront it. This is John Money Discipline. If you want clear, disciplined analysis without noise, subscribe to the channel, turn on notifications, and stay ahead of the math before the math forces everyone else to catch up.